the short-term credit market is growing. More and more stores and companies are offering buy now, pay later schemes. But just how does this work and what are the pitfalls? Trend analyst and economist Bronwyn Williams joins us now to unpack this further. No doubt this offering comes at a time when consumers are very cash-strapped just because of the economic climate and the advent of COVID-19. So these are very attractive credit offerings to consumers. But what are the pitfalls, Bronwyn?
Yes, I think first it's important to understand that although these things are often billed as being interest-free, they do affect your credit scores and there are some hidden costs. In fact, quite often with these buy now, pay later schemes, which are sold as being interest-free, a completely risk-free way to sort of get what you want now and only have to pay later, when you actually read the terms and conditions, if you start to miss payments, as many people are doing, in fact, recent research is showing that 1 in 3 consumers that have taken on a buy now, pay later offer are falling behind in payments. Those failure to pay penalties can often be higher than your credit card interest rates would have been. And of course, if you keep on missing those payments, they will still list you with the credit bureaus and can actually end up impacting on your long-term financial future too.
Right, there are various offerings by different retailers, Bronwyn, but one that I find interesting is what we're seeing SMMEs offer out payday loans. Talk us through what those are and really just how consumers should be wary of this particular kind of loan.
Yeah, exactly. Payday loans, again, sometimes if you're in a particularly stressful financial situation, occasionally it might be necessary for you to start accessing some of your earned income before your payday rolls around. So say, for example, a geyser blows up or you're involved in an accident, you need access to cash. These offers can become very attractive in that the companies that offer these things, these sort of payday loans or pre-payday loans, will actually advance your salary for you so that you're able to access the money that you've earned through the time that you've banked before payday rolls around. But again, there are catches to these services. They do have fees, even if they don't have interest rates per se. And if you do miss those payments, again, it is going to impact on your longer-term financial future. What we've kind of got to see with these buy now, pay later schemes and these payday loans that are offering up to try and help consumers or to enable people to participate in financial inclusion. They really are, is what we're terming them at Flux Trends, as being debt training wheels. In that once you're kind of on that debt-based treadmill, if you're accessing your salary early 1 month for an emergency, sure, fair enough. But when it becomes a habit and you start to constantly be 1 month in arrears with your income, this can snowball, particularly in difficult economic times when the price of everything is going up, and it can trap people into cycles of debt that can be very, very difficult to break free from. So be very, very careful with the wording used here. They often billed as being, again, interest-free and no risk, but there are still risks. Debt still is debt, and it has to be repaid. And if not, there are consequences. And quite often these too good to be true schemes are actually too good to be true.
Absolutely, Bronwyn. Thank you for that.